Hi guys,
Hello.
how's everybody doing?
So
That's good. Well, what happened to my?
Yeah.
Okay, there.
All right. You need to go
You
downstairs.
you got a new classmate, huh?
Yeah, exactly. Oh, now you want him too?
I'm just finishing a little, I don't know, early dinner, late snack, whatever.
Mm-hmm.
So, while we wait and hopefully get a couple more.
I'll probably have my screen covered too, just because I've got dinner cooking upstairs. The timer's about to go off, so I'll be
No,
covered
no
until
problem.
it's
Yeah,
done and I'm done.
no problem, Langdon.
All right. Come here. You gotta go downstairs.
I see everybody has their power back.
Yeah, yeah, well, hopefully everybody. Oh, is it the whole city now?
mm-mm.
I
No.
still don't have my power.
There's still like 20-some thousand people that don't have power.
That's what I saw earlier. Yeah, yeah.
Yeah, I don't have power. I'm at my sister's house.
Oh wow.
Mine came back Monday night.
I got mine.
Monday.
I got mine Sunday afternoon, and as soon as the power came back, right away we had TV and internet and everything. Steve got his power Friday, and he still doesn't have TV or internet.
Who does he have?
MediaCom, same company.
Yeah, I've been hearing that a lot about MediaCom. I have I'm on. I mean, we don't have cable. We just stream everything. But we have internet, and yeah, my router, my modem worked right away, so.
Yeah, ours too. Yeah, it was I mean, it may have been because the lights were on when I went to Des Moines and then came home and the lights were on and nobody was there. So I don't know, maybe been on for a couple hours, but as soon as we checked, the internet and TV were working.
There's still a lot of places by my work on Southwest 16 that big sections of the street that still don't have power, and on the cross street there by Edgewood and down toward Lindale, no power down there. Today was actually the first day that we saw line crews working along Southwest 16.
Oh, really? Yeah.
They've been running on generators.
Yeah. I had my car into Havlik Auto Service there. And he was on a generator still. I picked it up yesterday. He was still on a generator yesterday. Anyhow.
Yeah.
No. Yep. No, it was when did we start getting hurricanes in Iowa? Anybody wants to doubt the climate change thing, I'm like, no, I believe it, because they said it was going to cause extreme weather events, and that's the most extreme event I've ever seen. So
Yeah.
and I'm sure you all have damage to your places too. Mm-hmm.
Yeah, I mean, nothing for us, luckily. I mean, it's
Minimal.
Not a lot. I mean, we lost our garage door and some siding and some shingles, but
yeah, that's us too. Yep. So we're gonna have
a lot of people have.
Yeah, I already had a new garage door put in, and then my son's company is going to do our roof and our siding. So, and I meet with the insurance adjuster Friday morning. So I'm hoping I get a whole new roof, and the siding is damaged on 3 sides. So I'm hoping I get a new roof and all new siding. But my house is only 9 years old, so it wasn't that old to begin with, Well, I don't know if anybody else is going to be joining us. Let's see. Well, share screen here. Okay. And kind of trying to remember exactly where we left off last time, I think. So let's do this.
We finished, I think, chapter 16, and then you were gonna go through the other, like you said.
18, 19.
Yeah.
Yeah, 18, 19, 20, and 21. Mm-hmm. Okay. So, well, come on, Cubs. We got 2 men on. I got the TV Cubs game on in the background here. All right, base hit. That'll score 2. Okay. Ooh, close play at the plate. He's safe. Yes. Okay. Well, let's see. We'll go to content. Oh, you guys noticed that I had to change that due date. Originally, I was going to make it Monday at like midnight, Monday night. And, but then we got an email from the registrar saying grades are due Monday at 8 a.m. So, so I had to change it to Sunday at 5 p.m. for the due date and time for the test. So, if somebody can't make that work, or, and I may not even know about it yet, there may be people still without power that haven't, had access to email or anything else yet. So, for anybody that can't do it by then, if they just let me know, figure something out, even if we temporarily have to give them an incomplete for a day or 2 until they get it, made up. Okay, so we were going to, I think what I'll do is go through, I think I had a whole bunch of these handouts for, so we went through capital budgeting. We did 12 and 16 then. We've not done 18. So let's talk about 18. We did that stuff I put on there last time. So we did get the stuff on 16 covered. Down, isn't it? Oh, there it is. It's down here. Sorry. Okay. Like, where is it? Okay. All right. So we went through all that on modified internal rate of return and whole idea of mutually exclusive investments. We went through the lease thing. We did stock. Oh, we did not do stock splits and repurchases, did we? No. Okay. So, again, a stock split is where companies just split their stock into more shares. So the way I always tell students, and I think some of you are maybe familiar with this concept already, but it's like if you have a pie, you can cut that pie into 4 pieces or 8 pieces, but it doesn't affect the total amount of pie in the pan. Same thing with a stock split. You can split it 2 for 1, 4 for 1, whatever, but it doesn't make the company any more valuable. It just means there's more shares outstanding. So if you split it 2 for 1, basically the price is going to get cut in half. Somebody, I think it was Apple, just announced, because stock splits used to be extremely common. They've gotten a lot more rare lately. And that's why you see companies, like Amazon, trading at $3,300 a share, or, $1,500 and some for Google. It's over $400 and some a share on Apple. Apple did just come out with a 4-for-1 stock split though. So kind of unusual because most companies aren't doing it anymore. The idea is, typically up until very recently, if you wanted to buy stock in a company, you had to buy whole shares. You couldn't buy fractional shares. So, you know, if I've got $2,000 to invest, I couldn't buy a single share of Amazon with $2,000, right? Because it's trading at $3,300 a share. Just very recently, some online brokers are starting to allow fractional share purchases. So, you know, if you wanted half a share, they'll find somebody else who wants a half a share, and you can buy it that way and own it that way. That has been a very recent development. Most brokers still don't do it that way. I can't do that. I can't. If somebody tells me I want to buy half a share of Amazon, I can't do it for them. Well, I guess I haven't tried, but I'm pretty sure I can't. You know, it is, you know, when companies' stocks would get really expensive, you know, they would want to split it just to make it more affordable. And then more, also that makes it then more attractive to especially smaller investors. So the idea is, well, we split the stock, and then we'll see bigger price increases because we'll have a larger market for the stock than we otherwise would. So that's why companies do that. Now, stock repurchases entirely different. Oh, by the way, there is such a thing as a reverse split, which does just the opposite. So like a 2-for-1 split says for every 1 share you previously owned, you'll own 2 shares afterwards. Well, you could have what we call a 1-for-2 reverse split, meaning that every 2 shares you previously owned are now going to be combined into 1 share. The idea behind that is just the opposite of the idea. Well, the goal is the same in both cases, whether it's a stock split or reverse split. You're trying to open up a larger market of buyers for the stock. In the case of a stock split, you're doing it by reducing the price because you feel like at a really high price, not as many investors are going to purchase the stock. But with a reverse split, it's the opposite. It's when your stock price is very low, like say $1 a share. Well, those are we call those penny stocks. In fact, anything under $2 a share pretty much is considered a penny stock. Penny stocks are notoriously risky. A lot of investors will not consider buying penny stocks. So the idea is, number one, we can appear less risky and open ourselves up to a bigger market of buyers if we can increase the stock price by doing a reverse split. So that's when companies will do a reverse split. The other thing is, for instance, on NASDAQ, you cannot be listed if your stock price falls below $1 a share for a certain period of time. I can't remember if it's 30 days or 90 days, something like that. But if your stock stays below $1 a share for any length of time, it gets delisted. And then, of course, the trading and activity goes way down in that stock. So when companies have a low stock price, they'll do a reverse split trying to bring the price up. When they have a high stock price, they'll do a split trying to bring the price of the stock down. Now, stock repurchases are where the company simply buys back shares of its own stock. And of course, the idea there is if you bought back shares of your own stock, it's going to reduce the number of shares outstanding. And because now your earnings are going to be spread among fewer shares, it's going to increase earnings per share, which usually is going to result in an increase in the stock price as well. So that's the idea with a stock repurchase. Is it always a good idea? Not always. If you're overpaying for your stock, it's not a good idea to buy it back. But if you've got a lot of cash, usually it's companies that have a lot of cash. They don't necessarily have a lot of options with that cash in terms of good investments for the firm to make. investments that are going to give them that positive net present value or that internal rate of return that exceeds their WACC. So if they don't, if they don't have a lot of other uses for their cash, then eventually they can buy back stock. And again, it makes a lot of sense if there's no better options, and if they're not severely overpaying when they buy back the stock. So that's chapter 18. Any questions on stock splits or repurchases? I'll go back to my full screen here. We got Ishmael now too. How you doing?
Good. How are you guys?
Good.
How's everything
Yeah.
going with the storms?
What's that?
How's everything going with the storm and network connections problem?
Oh, sure. Yeah. Which a lot of people still have. So yeah.
Yeah, I'm just now changing the place because of the internet. I came to a different place.
You had to go to a different place?
Yeah, I've been at home, but I see something going on. There's no one to connect. I came to the office here. I see now it's good.
Yeah. I think the college has some places, some buildings and rooms people can go into for internet access. So,
Oh yeah.
as a last resort, if you want to go up on campus, just be careful. They'll stick a shovel or a rake or something in your hand. They're still doing a lot of cleanup up there. So, I haven't personally had a chance to go up and help out with that, but I know they're doing a lot still. So, yeah. Okay. Well, any questions on stock splits, reverse splits, or repurchases? No? Okay. All righty then. Well, okay. We'll go back to this view. All right. So that's that one. So now we just got 3 more chapters to go. 19, 20, and 21. So this is convertible bonds. I think that's chapter 19. And then I have other handouts for the other ones. Just looking what all I do have here. Yeah, okay. So convertible bonds. Get that downloaded here. Yeah, download. There we go. Convertible bonds. Okay. So, and I don't know if you guys had a chance to look these handouts over before class or not, or look at the chapters and all that. So convertible bonds are simply bonds that are convertible into shares of stock, and that's at the investor's option. So it's not like the company can turn them into shares of stock. The investor has the right to change the bond into so many shares of stock. So $1,000 par value bond. Well, I guess I've got it all laid out here, so I'll just go through it line by line here. Obviously, the advantage to investors, you get the safety of a bond, but you still get a chance for price appreciation in the stock. And so they've got a lot of the upside that you have with stocks, not all of it, but a lot of it, without nearly as much downside as stocks have, because, thing is, well, like I've got laid out here, take this example. You got bond with a par value of $1,000, coupon rates 5% annually, tax rates 20%. Let's say that's convertible into 50 shares of stock. Okay. Now, if at the time the bonds are issued, the stock price might be, in this example, $15 a share. Well, 50 times 15 means that those 50 shares would be worth a total of $750. But you know what? You got a bond that's going to be worth right around $1,000, right? So the conversion value of 750 is less than the par value always when the bonds are initially issued. But then what happens is if the stock price, you know, over time, stock price goes up and to say $25 a share. Well, now 50 shares times $25 a share, that's $1,250 worth of stock. So that would be the price that the bond would start trading at then, right around $1,250 a share. So whenever the conversion value, in other words, that value that all those shares would be worth if you converted the bond into stock, that conversion value, once that exceeds par value, the bond price will start basically equaling, you know, sometimes off by a smidge, but it will basically equal that conversion value. Now, the nice thing is, let's say all of a sudden the stock drops back down to $15 a share, so those shares would only be worth $750 again. Well, then at least you still got the bond that's worth $1,000. So you've limited your downside risk, and at the same time, you know, you've been able to take advantage or may have been able to take advantage in upside potential in the stock price as well when the stock price goes up. So it's kind of like the best of both worlds for investors. I got the safety of a bond, but I got the chance to make money off the stock. Now, you're not going to make, you know, there's no such thing as a free lunch, as they say. You're not going to make as much if the stock price goes up as you would have if you had just bought the stock outright. I mean, take this bond, you know, if you pay $1,000 to buy the bond and eventually the stock it's convertible into becomes worth $1,250, well, you'd have a $250 gain. But of course, if you just bought the stock directly instead of the bonds, if you just bought 50 shares at $15 a share, and then it goes up to 25, now you've gone from $750 to $1,250. So you made $500 instead of just the $250 if you buy the bond. So there is a trade-off. You're not going to get as much upside as if you just bought the stock directly. Okay, but you also don't have the downside you would have if you just bought the stock directly and then the stock price tanks, because again, with the convertible bond, usually worst case scenario, the bond will at least trade somewhere around par value no matter what happens to the price of the stock. Now, what's the advantage of the corporation? Well, they don't have to issue as many shares of stock for the same dollars raised. Like here, you know, you're raising $1,000 by giving somebody the right to convert that bond into 50 shares of stock. If you wanted to raise $1,000 by selling the stock at $15, what is that? 66.67. I'm going to say off the top of my head, but let me just double check. Why am I 15? Yeah. You would have to have issued 66.67 shares at $15 a share in order to raise $1,000 if you issued stock directly. By issuing a bond for $1,000, you only end up eventually, if the bond is converted to stock, you're only giving up 50 shares rather than 66.67. So again, for the same dollars raised, it allows you to issue fewer shares. And also, convertible bonds carry a lower yield than non-convertible bonds, if, you know, all else being equal. So other bonds with the same coupon rate, maturity, and rating by, say, Moody's or Standard & Poor's. So you take two bonds that are basically identical. One is convertible, one is non-convertible. Well, which one would investors prefer? Obviously, and more options are always preferred to fewer options, right? Except when you're asking a little kid at a restaurant, you know, what to drink, you know, what they want to drink. You don't give them too many choices. I don't know if you guys have had that experience, but, you know, if you don't tell a 5-year-old, well, and list off all 8 drinks they have. You list like 2 and let them pick, because they'll take all day trying to pick. I know some adults like that too. So anyhow, Yeah, so people would rather have more options, so they'd rather have a convertible bond than a non-convertible bond. So because of that, they'd be willing to accept a little bit lower interest rate or yield on the convertible bond than what they would want on a non-convertible bond. So whereas this one here, okay, let's say at the time it was issued, you know, the yield demanded by investors on that convertible bond was about equal to the coupon rate of 5%. Well, if it was non-convertible, that bond might carry a yield of 6% instead of 5%, you know, type thing. So the convertible bonds for the corporation have one advantage over non-convertible bonds in that they'll have a lower yield or interest rate on them. And of course, in terms of versus just issuing stock outright, they can raise as much money for fewer shares issued by doing it with convertible bonds. I tell you who had a lot of convertible bonds is Tesla has always had a lot of convertible bonds. So in fact, yeah, if you, we've done this before. I know we have gone to, let me do this. Let me go back on our web here. Remember when we went to FINRA.org? And whoops, what am I looking for? Maybe oh, for investors. Okay, it's over here. And tools and calculators. And then we go down. Where the heck is it? I know I even sent you guys the exact link. Oh, it's under FINRA market data. And then under bonds. Okay. So if we take a look at Tesla, for example, so we'll do a search. Tesla. I think we did. Did we look at Tesla already? Just the ratings, I think. We didn't look at anything else, did we, when we looked there? Okay. So here's Tesla's list of Tesla's bonds rated. This is interesting. This one, which happens to also be a callable bond, talk about that here in a minute, has the lowest Moody's B rating, because B1 would be the highest, then B2, then B3, but has the highest Standard & Poor's rating of B+, because it goes B+, B, and B-. So that's interesting. They're a couple of grades off from each other. Usually they're either the same or one grade off. You usually don't see them like 2 grades off like that. But yeah, if you look at these bonds, well, why would anybody buy a bond with a negative yield? Look at these first couple. Both have huge negative yields. So does this one down here. Why would you buy a bond where, in other words, that means that's the yield to maturity. If you held it to maturity, that's your annual rate of return would be negative. In other words, you're getting back less money than you paid out. Well, why would anybody do that? And of course, the reason they do that is because it's convertible. So if we grab this one here, okay, what we're going to see, let me move us and out of the way over here as much as I can. Okay. So you see different things, but right here, bond type, it's a U.S. corporate convertible bond. Okay, so it is convertible into shares of stock. Now, what's the current price of the bond? They give the ratings and stuff like that down here. Oh, must be up here. Last trade price, $528.12. Now, remember, that's bond prices are quoted per $100 of par value. So they're paying $528.12 for a $100 par value bond. Why? Because of the number of shares that it is convertible into. And in fact, if we look at the prospectus real quick, and I don't want to spend a lot of time on this, but you know, we'll take a quick look here. So if we go there, and I don't know what the difference is between these two, about the same. Okay, so the one we were just looking at is a 1.25% convertible senior note due 2021. Okay, and includes maybe purchase percent. Okay, and conversion includes an indeterminate number of shares of common stock. That's number 4 down here. Okay, so says includes an indeterminate number of shares of common stock issuable upon conversion of the convertible senior notes at the initial conversion price of approximately $359.87 per share of common stock. Pursuant to Rule 416 under the Securities Act, such number of shares of common stock registered hereby shall include an indeterminate number of shares of common stock that may be issued in connection with a stock split, stock dividend, recapitalization, or similar event. Okay. So it is convertible into, it says stock at $359.87 per share. Okay, now that's so I'm just trying to think, what is the stock price for Tesla today? If we check that, just go on Yahoo here quick. Okay, Tesla. I know it had been up over like $2,000, I think, at one point. There it is, 1878.53. So if I take today's closing price, 1878.53, and then I divide that by that price they said, oh, I thought I just minimized the prospectus. Where'd it go? Well, it was 359 something. So I'll just divide that by 359. That's 5.2327 shares. So or in other words, that's what one share today is worth 5.2327 times that $359, of which it could be, you know, which would be the conversion price of the bond. So, okay, well, so if what am I trying to do here? Usually they give you the number of shares, and that's why. Okay, let me go back to this. Oh, wait a minute. I think I know where there's the prospectus. So how many shares is that actually? I'll make that a bit bigger so I can read it. And I'm going to bust down here for a minute. Okay, so 1.25%. Holders may convert their notes at any time on prior to close of business. December 1st, 2020, during, under the following conditions, et cetera, et cetera. Trying to find the exact number of shares that would be convertible into. So, conversion rate, there we go. The conversion rate per $1,000 of bond is 2.7788 shares. So if we take 2.7788 shares times the current market price, which was 1878.53, that's going to get us probably, should get us pretty close to what the price of the bonds are currently trading at. 2.7788 shares times 1878.53. Yeah, that would be 52.20. So that bond is convertible into $5,220 worth of stock, $5,220 worth of stock, and the bond was trading at 528, so a little higher than 522. Because again, remember that's per $100 of par value, so that's really $5,281. And again, the stock it's convertible into at today's price is $5,220. So that's why investors are willing to pay that much and accept what would be a negative yield if they held the bond to maturity, because they're not going to hold it to maturity. They're going to convert it. Usually, though, they have to be enticed to convert it because they'll wait till the last minute. Why? If the price goes higher, they can always convert it later on at an even higher price. If all of a sudden something bad happens, the price falls through the floor, falls off a cliff, they still got that bond worth $1,000, So that's they're going to usually want a little bit. And let me go back to our other view here. Okay. So they're going to need sometimes a little bit of a kick in the pants to get them to convert. So convertible bonds are also usually callable. So the company will say, okay, we know you're going to convert these bonds into stock anyhow. Let's just get that debt off our balance sheet. Let's stop having to pay all that interest. And let's just force a conversion. We'll just call the bonds in and say, hey, on a certain date, we're going to give you $1,000 for your bond if you still hold it. Well, of course, nobody's going to want to hold it on that date if the stock is worth way more than the bond. So that's the time when everybody will rush out and convert the bonds. So they'll either do it right before the bonds get called or right before the bonds mature. Okay, so then continuing to look at this example, I'm going to move us over here. Okay, so, if you had a $1,000 bond convertible into 50 shares, the conversion price would be $20. So if you wanted to raise $5 million by issuing bonds at $1,000 a bond, you would have to issue 5,000 bonds. Each of those bonds is convertible into 50 shares of stock. So that means you would have to issue 250,000 new shares, assuming all the bonds do get converted into shares of stock. Now, if the company wanted to raise $5 million at the same point in time, instead of using convertible bonds, if they just wanted to issue stock directly to raise $5 million when that stock was trading at $15 a share, instead of 250,000 new shares, they would end up having to issue 333,333 new shares. Okay. I already mentioned the forced conversion. A company calls in the bond issue, forcing investors to convert to stock. I mean, they don't have to convert it to stock, but of course they're going to, because that's what would make the most sense to them. Why accept $1,000 for a bond when you can get converted into $5,000 worth of stock, right? Now, diluted earnings per share is another topic from this chapter. Diluted earnings per share equals your adjusted net income divided by the new number of shares that would be outstanding if the bonds were convertible to stock, converted to stock, I should say. So, when you have convertible bonds, you're going to have, there's the potential for diluted earnings per share. So all companies report two earnings per share numbers, okay? They report primary earnings, or basic, I guess we call it, basic earnings per share, which is just the earnings per share based on the current number of shares outstanding. Then they also report diluted earnings per share. Diluted earnings per share is the earnings per share you would have if everything that could become stock did become stock. So that would include, like, what if all the convertible bonds got converted into stock? It would also include, for example, stock options the management has. You know, management is compensated with stock options, which gives them the right to buy stock at some particular price. And so it also would assume that management, what if management exercised all their options to buy new shares of stock in the company and things like that. So that's diluted earnings per share. The earnings per share you would have if everything that could become an outstanding share of stock did. So I give you this example. Let's say for basic earnings per share for this company, we have $6 million of income, 2 million shares outstanding. So basic earnings per share is $3 a share. Okay. Now, adjusted earnings from the previous example. Now, remember, we said in that example, we were raising $5 million of debt at a 5% annual interest rate, which 5% of 5 million is 250,000 of annual interest expense. Now, if the bonds get converted, we avoid having to pay that interest expense. Now, again, interest is a tax deductible expense. So the after-tax savings would be the 250,000 times 1 minus the 20% tax rate, or 0.80. So net income after taxes would go up by $200,000 if those bonds are converted to stock, because the company would no longer be paying interest on those bonds. So your adjusted earnings would now go from $6 million to $6,200,000. But of course, there would also then be more shares of stock outstanding, because again, there's already 2 million shares outstanding. And then, like we calculated above, for the company to, raise $5 million, and by making each bond convertible into 50 shares, that would result in 250,000 new shares of stock if all the bonds got converted. So the number of shares outstanding would now go from 2 million to 2,250,000 shares. So now your diluted earnings per share is the new income figure, 6.2 million, which is the original 6 million, plus the $200,000 after-tax interest savings, divided by 2,250,000 shares, which is the current 2 million shares outstanding, plus the 250,000 new shares that would be issued if all of those bonds did get converted into shares of stock. So the diluted earnings per share in this example would only be $2.76, even though, remember, basic earnings per share was $3. So does that make sense, computing diluted earnings per share with our convertible bond example? What do you think? Any questions? No? Okay. All right. Well, we're done with that chapter now. Just 2 more to go. So let me move that one down. Let's go back here and move this over. Now we got 20 and 21. Excuse me. Okay, so for chapters 20 and 21, and then I'll also go to this exchange rates thing here too, and look at that one as well. Download it here. Okay, so first of all, one of the things we're looking at is the math with regard to an acquisition if you know, company A acquires company T, okay, and it's a stock for stock exchange. A lot of times in a merger or acquisition, it'll be a cash, you know, it'll be a cash trade. So, but sometimes it's a share exchange instead. They say, okay, we'll give you X number of shares of our company in exchange for X number of shares of your company. Okay. So that's the example we're assuming right here. So let's say company A was making $4 million a year, had 2 million shares outstanding. So it's got earnings per share of $2. Company T, and I call it A and T, A for acquiring company, T for target company. So company T has $2 million of earnings. They also have 2 million shares outstanding. So earnings per share is $1 per share. Now, notice that the market price that the company A is willing to pay for company T is $30. Okay, so that on company A's PE, well, let's say the market price in the market right now for company A is $30 a share. Okay, so that means if their earnings per share are $2 and their price is $30, their price to earnings ratio or multiple is 15 times. Okay, now let's say company T, they agree they're going to buy company T for $30 a share. Well, divided by the earnings per share of $1 a share means the price to earnings multiple they're effectively paying for the target company is 30 times. Okay, much higher than their own PE. And we're assuming it's going to be a 1-for-1 share exchange, because if our stock is worth $30 a share and that's the equivalent of what we're going to pay for the target company's stock, then we'll give up 1 share of our stock worth $30 for each share of the target company we acquire. So then if you look up here, you see that, well, okay, what would we expect earnings per share to be the next year? And if we look, well, if it was 4 million and then 2 million for the acquiring company, 2 million for the target company, combined, they should have earnings around 6 million. Now, because it's a 1-for-1 exchange and company A already had 2 million shares outstanding, and then they would have had to have issued 2 million more shares for company T, there would now be 4 million shares of stock outstanding. So earnings per share after the acquisition would be $1.50 a share. Okay. Now, and you might wonder, well, why would a company, if they know that based on the acquisition price and the number of shares and they have to give up, if they know their earnings per share is going to go down, why would they do that? Well, typically they might expect it to go down initially, but excuse me. But anyhow, by the way, one of our good friends is in the hospital with COVID right now, and now my wife's boss's boyfriend just tested positive with it. She's been around both him and her, helping clean up stuff, and so now she's getting tested. Her boss and my wife's getting tested, and yeah. So I don't know. And then if she has it, I probably haven't. So we'll find out. Anyhow. So why would a company do that? Well, the idea is that they're probably looking at the target company as a growth prospect in this case, where they think, yeah, initially earnings per share will go down, but over time, because of the growth prospects of this company, they probably expect that 2, 3, 4 years down the road, they're going to have more earnings per share by acquiring that company than they would have had without. Now, I do a similar example down below. The one difference is this time we're assuming that we're only going to pay $15 a share, the equivalent of $15 a share for the target company. Since our stock is worth $30 a share, we'll give up half a share of our company stock for each 1 share of the target company stock, right? Because our 1 share is worth 2 of theirs. So it's a half a share for 1, or if you want to say 1 for 2, whichever way you want to look at it. We'll give up 1 share of our company for every 2 shares we acquire in the target company. Now, in that case, note that the effective price to earnings multiple we're paying is 15 times. And notice what happens then to earnings per share. It wouldn't actually be expected to change. You still have combined income of 6 million, but now you'd have 3 million shares outstanding instead of 4 million. Why? Because you currently have 2 million outstanding, and then you'd have to issue half a share for each of the 2 million shares in the target company. So that would be another 1 million shares you'd have to issue. So you have 2 million outstanding, you have to issue another 1 million. That gives you 3 million total. 6 million over 3 million gives you $2 in earnings per share. Okay. And then finally down here, I do one more example. This time, I assume we're going to pay only $10 a share for the target company, in which case, okay, our stock at $30 a share is worth 3 times as much as what we're acquiring the target company for. So we're going to give up 1/3 of a share for every 1 share in the target company. Or another way to look at it is we'll give up 1 share for every 3 shares we get in the target company. Then look at what happens to earnings per share. Again, combined income would be 6 million. Now the number of shares outstanding would only be 2,666,000. That would equal the 2 million already outstanding plus the 0.333 shares times the 2 million shares of the target company that we'll be issuing, which should be another 666,000 shares. So 6 million over total number of shares of 2,666,000 would give us a higher earnings per share number of 225. So note, okay, that when the price we were effectively paying for the target resulted in a price to earnings multiple higher than our own, 30 times versus 15 times, what would we expect to happen to earnings per share? We'd expect it to go down from $2 to $1.50. When we were paying a price such that the PE multiple we're effectively paying for the target equals our own, the expected earnings per share would stay at $2 a share. And if we're acquiring the target company at an effective price that results in a lower PE than our own, like in this last case, then earnings per share would actually be expected to go up, like we see from $2 to $2.25 in that example. Okay, so that's just a little math with figuring out, what to expect for earnings per share in the year after an acquisition, given, the various data that we have there. The one other thing I did want to talk about in this chapter, and I don't know, maybe I did not have a handout on it. Let me check. Was just motives for, maybe it's in the review if it's not in here. Let me just scan through real quick. The motives for an acquisition. Why would you want to acquire another company? And I think that's going to be in that. Darn it. Didn't I have a review sheet in here with review topics for the final? Thought I did. Study topics
They're
list.
in the study topics, yeah.
Yeah, thank you. Yeah, okay. Review topics for the final exam. And so, yeah, let's go ahead and download that too. There we go. Oh, I just mentioned the pages for the motives for mergers and acquisitions. Generally, what would be the main reasons behind one company wanting to acquire another company? And most of the time, probably ultimately the biggest goal is growth. A lot of times a company will buy another company because their revenues and earnings might be growing faster than your own company. So growth, to acquire growth. And you can acquire growth in different ways. That could include, well, we get that company's products. Could be we get that company's territories that we've never sold in before, whatever. So you expect to grow earnings faster after an acquisition than before. That could be one of the reasons. There can be other reasons. Synergies is a big one. SYNERGYES, synergies. What does synergies refer to? That's where the two companies operating as one can be more profitable than the sum profitability of the two companies operating separately. For instance, Men's Warehouse, and did you see they filed for bankruptcy recently? Men's Warehouse acquired Joseph A. Banks quite a few years ago. Anyhow, one of the things they were looking at is synergies, saying, well, the two of them both sold the same kind of suits from the same suppliers. It's like we're going to have a lot more clout, negotiating clout with these suppliers if we're buying suits from them as one combined company than the clout we have when we're buying as separate customers. So that's the idea of synergies. There can be some cost savings, either because you have more buying clout, or maybe maybe you can eliminate some duplication of effort, between the two companies. So you can cut some costs there. Sometimes you can cross-sell each other's products. When it's two companies that maybe have complementary products but not identical products. So, oh, well, you know what? We can help sell their product as well as ours and vice versa. And that cross-selling may result in more sales total than if the two companies were operating separately. And then I'm going to mention one other one. Those are the main ones: growth, or again, synergies. There can be others. Patents. Sometimes you want to acquire patents in technology areas. Yeah, that's why years ago Google bought Motorola. And everybody's like, why would Google buy Motorola? Google's in the software business, which, number one, has much higher profit margins than the hardware business. And number two, besides having higher profit margins, it also has more growth, right, than the hardware business. So they're like, why did they buy a hardware company like Motorola that won't have as high a profit margins as Google, and doesn't have as much growth potential as Google, but excuse me, and they paid like $12 billion, which this was probably 10 years ago, so it'd be worth probably closer to 18 billion or something today. Anyhow, the reason they did it was they wanted the patents because Motorola had literally thousands of technology patents that Google wanted to access. So that was their reason. So there can always be, or maybe you're trying to get a certain expertise in your company that you didn't have before, you know. We look at a case and cases in finance where one company's really good at custom making and building precision parts on a small scale. The other company wasn't very good at innovating things or any of that, but they were good at manufacturing in big quantities. So the two of them together could make sense because, hey, your company's great at developing new products. We're great at mass manufacturing, which you guys aren't great at. Together, we can complement each other's businesses. The one bad reason for a merger or acquisition is diversification. Sometimes companies that used to be real popular, like in the 80s, diversify, get into companies unrelated, whose business line is completely unrelated to your own. Why would you do that? Well, the idea was safety. It makes us a safer company because if our industry goes through some rough times, maybe this other industry will be having good times, you know, and vice versa. So that's the idea with diversification, was it made the company not only bigger, but it also made the company safer. Well, that's a bad reason for an acquisition. And why? Because most diversifications just historically have not worked out very well. The vast majority of times, those companies did not do a good job of running, the one company did not do a good job of running the other company they acquired, because, you know, if I'm, I don't know, in a car business, what do I know about, you know, the tobacco industry or something like that, you know, if I was to acquire a tobacco. I mean, so most diversifications just haven't worked out well historically. The other thing is, the way I look at it as an investor and a stockholder, I don't want, if I own a company that's, say, in aerospace, Collins, okay, Rockwell Collins, before it was then bought by United Technologies, which has now been since bought by Raytheon. Okay, but anyhow, if I want an aerospace company, I'm investing in that company because it's an aerospace company. If I want to diversify my investments, I'll do that on my own. I'll go out and I won't just put all my money into aerospace companies. So in other words, what I'm saying is, I don't want the company's management assuming they know what's better for me than I know. If I want to diversify my own portfolio, I'll do that myself. I don't want companies I own stocks in to try to do that for me. Okay. So, and there's a guy named Peter Lynch, wrote a couple of books, one called One Up on Wall Street. He also wrote a book called Beating the Street. He was an awesome stock picker for oh gosh, was it Fidelity Magellan was the fund that he managed. Trounced the overall returns of the S&P 500 almost every year. And so he wrote books, and throughout his books, he refers to diversifications as diversifications, saying, yeah, it diversifies the company, does not make them better, it makes them worse. Okay, negotiated versus tender offers. The difference areas with a negotiated offer, the management of the two companies comes together and forms an agreement for the company to be bought out. Now, it still has to be agreed upon by the shareholders, but that's a friendly takeover. In a hostile takeover, usually what happens is management of the acquiring company approaches the target company and they can't work out a deal. And so they say, you know what, fine, we'll just take our deal straight to the shareholders. So they'll just put out a tender offer and say, hey, you can tender as many shares as you want at such and such a price. And so if they can acquire over 50% of the shares, now they have a controlling interest in the company. That's tender offers. They're used in hostile acquisitions. Negotiated offers are where the managements make a friendly acquisition, agree to a friendly acquisition. They talk on page 643 about premiums. Generally, when one company buys another, you're going to have to pay a premium for its stock, right? If the stock is trading at $20 a share, you're not going to be able to buy over 50% of the shares in that company for $20 a share, right? So the only way you're going to get a majority of the stock is to pay a premium over and above where the stock is currently trading. Premiums typically average anywhere from 30 to 50%. So in fact, I could even put that in there. Just put 30% to 50. Yeah, so in other words, if a stock was trading at $100 a share, in order for me to acquire a controlling interest in the company, I'm probably going to have to offer shareholders at least $130 a share and maybe as much as $150 a share in order to get a controlling interest in that company. That's chapter 20. Any questions on 20? Okay, finally, chapter 21 on exchange rates. We want to talk about who benefits from a strong dollar, who benefits from a weak dollar. Now, we know the Federal Reserve has printed up a bunch of money here to fight this whole economic crisis that's resulted from the economy being shut down because of COVID. So they printed up a lot of money. Well, that has weakened the value of the dollar. Okay. And of course, where a lot of that money has landed is they're buying like treasury bonds and notes and bills. And so that's driving up the price, and which of course in turn drives down yields on those securities. So when interest rates are low and the money supply has gone up in your currency, that's going to weaken the dollar, and that's been happening lately. Right now, I think it takes $1.19 to equal 1 euro, whereas 3 months ago it was like $1.06 to equal 1 euro. So the dollar got weaker against the euro because now it's taken more dollars to buy a euro than it did before. Like I say, now it's about $1.18. It had been like somewhere around $1.06, as I recall, just a few months ago. Now, do we want a strong dollar or do we want a weak dollar? Kind of it's not really a trick question, but it kind of is, because I know the response I'm usually going to get. And the response I usually get is people say, well, you want a strong dollar, right? And they think that because strong always sounds better than weak, right? I mean, if you asked women out there, do you want to be married to a strong man or a weak man? What are most of them going to say? Well, I'd prefer to be married to a strong man, Now you will find the occasional woman that says, no, I want a weak man. I want somebody I can order around, tell what to do, and make my little bitch, right? Yeah, so there are definitely those too, but most people would say strong just because, well, it sounds better to be a strong person than a weak person. So most people would say a strong dollar is better than a weak dollar, but it depends on the perspective you're looking at it from. Okay, because here's the deal: a weak dollar is good for U.S. businesses because it makes our goods cheaper overseas, as well as, makes our goods cheaper overseas when the dollar is weak, okay? But it hurts consumers to have a weak dollar, because now when you buy goods, especially if they're imported from overseas, when the dollar's weak, you're going to have to pay more dollars rather than less dollars. In fact, let's go straight to my exchange rate handout here on Brightspace. Instructional handouts. And there we go, exchange rates. I think I've got some examples here. Oh, well, I don't have any examples. I just have this showing what we're looking at here is what causes the value of the US dollar to change. Okay. Now, so let's go through that, and then I'll just below this, I'll put some examples of why you know, a weak dollar may help exporters, but it hurts U.S. consumers. Okay, so I'll do that afterwards. So yeah, let's look at the things that affect. Yes, Laura.
You have it on the 2021 handout.
Oh, I do. Okay, have I got that one downloaded yet?
It's at the bottom.
Oh, thank you. Yeah, yeah. Okay. So, yeah, perfect. So, US dollar relative to euros, let's say $1 equals 0.9174 euros, or another way to look at it is 1 euro equals $1.09. We'll call that a strong dollar. Okay. Now, if you're a US merchant, you're selling goods in Europe for the equivalent of $1,000 per unit, then you would have to charge at that exchange rate, you would have to charge 917.4 euros to get the equivalent of 1,000 US dollars. Okay. Now, European merchant sells goods in the US for the equivalent of 500 euros per unit. So since it takes $1.09 to equal 1 euro, 500 euros would be worth $545. So that would be the price of the goods here in the US. Now, let's say all of a sudden the exchange rate changes. So the dollar has just gotten weak. Now we have a weak dollar. So the dollar, $1 is equal to 0.8333 euros, or 1 euro is now equal to $1.20 instead of the previous $1.09. What's going to then happen to the price of the goods being sold by the US merchant in Europe and by the European merchant in the US? So the US merchant, again, they still want the equivalent of $1,000 per unit, but now because it only takes 0.8333 euros to equal $1, they can lower their price from that 917.4 euros per unit down to 833.3 euros per unit, and they're still getting the same number of US dollars. So a weak dollar helps US businesses by making the goods we sell overseas cheaper. And actually, even if a company didn't sell goods overseas, they're still helped by a weaker dollar because it makes their goods that they sell domestically more competitive against foreign imports. Take Harley Davidson, okay? Now, Harley Davidson does sell bikes in other countries, but in the US, they lost some market share to the Japanese bike makers, Honda, Suzuki, Kawasaki. And why did they lose market share to them? Well, for a long time, the yen got weaker against the dollar. Dollar got stronger against the yen. So that meant that the Japanese didn't have to charge as many US dollars for their bikes as they used to. So it made Japanese bikes cheaper relative to the Harley Davidson bike because we had a weak What'd I say? Weak dollar, strong dollar. Well, let me get it straight in my own head here. Oh yeah, because our dollar got weak. Yeah, they were able. I'm sorry, our dollar got stronger. The dollar got stronger. That made the Japanese bikes cheaper in the U.S. and that hurt Harley Davidson. So even domestic companies would prefer a weak dollar over a strong one because when the dollar's strong, it allows foreign importers to sell their goods more cheaply in the U.S. and it makes it harder for domestic companies to then compete against those foreign importers. So again, businesses would generally prefer, for the most part, a weaker dollar, okay? Now, on the other hand, consumers who buy goods would prefer a stronger dollar because now look what happens with the weak dollar. Again, the European merchant is selling goods in the US for the equivalent of 500 euros. Well, initially it took $1.09 to equal a euro, so they were having to charge $545 a year. Now, because the dollar got weaker against the euro, and it takes like $1.20 to buy 1 euro, they now have to raise the price of the goods they're selling in the U.S. to $600 a unit from $545. So consumers benefit from a strong dollar because you can buy your goods more cheaply when the dollar is strong. Businesses, though, that are producing goods tend to benefit more from a weak dollar because it makes their prices more competitive with foreign competition. Okay. So does that make sense? Yeah. Okay. Any questions on that example then? I think that's all of it there. Yeah. So any questions on that? Okay. Finally, what affects exchange rates? And that's here. And it's the things I've listed, and I show the direction and how they relate to the strength of the U.S. dollar. So U.S. interest rates. Now, if we hold all other factors constant, if interest rates in the U.S. go up, that's going to increase the value of the dollar. It's going to make the dollar stronger. Why? Because at higher U.S. interest rates, more money from around the globe will want to be invested in U.S. investments to take advantage of those higher U.S. interest rates. So if U.S. interest rates went up and everything else stayed the same and everybody else's interest rates stayed the same, then that's going to attract more foreign money into U.S. dollar investments. So you'll have more foreign money buying U.S. dollars to take advantage of those U.S. investments. So of course, in that case, that's going to drive up the value of the dollar. U.S. economy / stock market, same thing. Investors around the globe prefer to invest in a healthy, growing economy. They prefer to invest in a strong stock market. And so when the U.S. economy and stock market is doing well relative to other countries, that's going to attract more foreign dollars into U.S. investments. And again, that foreign currency will then be buying U.S. dollars so they can make those U.S. investments. And that's going to drive up the value of the dollar. Now, the U.S. inflation rate, that has an inverse relationship to the value of the dollar. So if all of a sudden inflation goes up in the United States, but it doesn't go up anywhere else, that's going to weaken the dollar. That's kind of what's weakening the dollar right now, is there is an expectation because the Fed has printed up so much money. And of course, we know economically, the economy is not producing as many goods, the U.S. economy, right? So if we're not producing as many goods, but there's more dollars now because the money the Fed has printed, there's more dollars in circulation a day chasing those goods, and there's fewer goods, what's the natural result? Higher prices or inflation. And it's because of that, and not that inflation is high now, but it's expected to go up in the future. Could be a year, could be a couple of years down the road, but it is expected to go up. And because that makes our dollar doesn't buy as much with a higher inflation rate, that's going to weaken the US dollar. Okay. Now, US exports, if they increase, that's going to increase the strength of the dollar. Why? Because let's say a US exporter sells goods in Japan, okay, and they collect Japanese yen, all right? What is the US exporter going to do with all those Japanese yen? Well, they might leave some of it in Japan and leave it in yen, but a lot of it is going to get converted back to US dollars. So now you've got yen buying dollars, which is going to strengthen the dollar. Okay. Now, US imports has an inverse relationship to the strength of the dollar, because when we buy goods from, let's take a Japanese supplier. A Japanese supplier sells goods in the US. So what are they going to do with the US dollars that we spend to buy those goods? They're going to take those US dollars and convert them back to Japanese yen, which is going to strengthen the yen but weaken the US dollar. Finally, global turmoil. That has a direct relationship to the strength of the US dollar. Why? Because the US dollar is considered global currency, okay? The US is the largest economy in the world. Eventually, we'll get passed by China, but for now, we are still the largest economy in the world. And we're a very diverse economy. We don't, like some countries, take Saudi Arabia. They're dependent on one thing for their whole economy, right? Oil. We're not like that in the US. We aren't dependent on a single commodity or a single industry for our economy. Our economy is a very diverse economy, and it's the largest economy in the world, which makes our economy the one that is the safest to invest in. And so whenever, and by global turmoil, that could mean a little skirmish breaking out somewhere in the world. It could, it could mean financial crisis somewhere in the world. Where are investors around the globe going to flock in times of crisis? They're going to flock to U.S. investments and the U.S. dollar because of the stability of U.S. investments in the U.S. dollar. Because again, it is the safest place to be in times of turmoil. In fact, there's a lot of times, for instance, the oil markets. Oil markets trade almost exclusively in U.S. dollars around the world. So even countries that maybe whose governments hate the United States, take Iran, their government hates the U.S., right? I think that's no secret. But I can guarantee you a lot of the oil trading that is done by Iran is done in US dollars, because other countries want to use US dollars rather than Iranian currency, and vice versa. Iran doesn't want their currency. They know the US dollars are always going to be worse. So whenever global turmoil heats up, whether it's financial turmoil, political turmoil, what have you, that tends to strengthen the US dollar, because it is, like I say, considered global currency. Ishmael, where are you from again, if you don't mind my asking?
I'm from Sudan.
Sudan, okay. So there's a Sudanese currency, right?
Yep.
But I'm guessing you could use US dollars almost anywhere in Sudan to buy things, right?
Yeah.
Or would I be wrong?
No, you're right. Right now is high inflation in Sudan. So if you compare it like $1 in Sudan, is say almost $4 to $5 or more most of the time. Back and forth.
Oh, okay. So it takes like 4 or 5 Sudanese dollars to equal 1 US dollar.
US dollar.
Right, yeah. Well, look at the yen. It takes 105 or 106 Japanese yen to equal 1 US dollar. Yeah. So, if you go to Japan and they tell you, we'll give you 1 million yen a year to work here. Well, 1 million yen a year is only 10,000 US dollars. So that's probably not a great job. Well, it sounds like it. Oh, wow, I'm making 1 million a year. Yeah, that's yen, not dollars. Okay. Well, that pretty much covers it, guys. Any questions over anything we went over tonight? No? Okay. The worksheet, there is a worksheet for the final. You want to take a quick look at that? I have the solutions, detailed solutions for it too. I mean, just take us a few minutes to run through it. We'll take a quick look at that, and then your course is all over. So, yay! Finally, right? Okay. So, let me go to the worksheets. Oops. Here, let me just go straight here. And solutions to the worksheets. Detailed solutions. Why not have detailed solutions for this one? I thought I saw it somewhere in the final. Okay, I do not have the detailed solutions. By the way, question 3 you can ignore on the worksheet. Okay, so in fact, let me just, yeah, I'm going to go right here and I'm just going to cross through that because you don't need to do number 3. Okay. All right, well, okay, and I'll save that. So that's not the detailed solutions. I thought I had them. Let me check down here. Solutions, exchanges. Let me just check one more time here on Brightspace. Because gosh, I could have sworn I had detailed solutions on there, but maybe not. Oh, by the way, I have not yet graded your last Excel assignment, the 30.1. So I still got to put that in. And of course, the Accepi 3. And other than that, it's just the final exams. Okay. Did I have it under instructional handouts, maybe? I don't think so, but let me just double check. Yeah, detailed solutions for worksheet for final exam. That's where it is. I should have put it under the worksheet solutions, but I guess I did. Okay, so we'll download that. Okay, and again, you do not need number. Oh, I only put 3 of them on here. Okay, so the one solution had 4 solutions, but what was previously number 3 on this worksheet, I took off the worksheet, so it's not on there. All right, so assume the following 2 investments, each cost $1 million. Required rate of return for both is 9%. Cash flows for the 2 are as follows. So investment A, investment B. We're supposed to determine the net present value, internal rate of return, and I should say the payback as well, because I did do the payback for both investments. So first of all, on the payback, and by the way, you have a problem very similar to this on the final. It is a 20-point problem. So, but it's very, you know, it's straightforward. You just do it just like we're doing this one. First of all, on the payback, remember, we're trying to figure out how many years does it take to get paid back for the investment. So since it was $1 million investment, if you look at investment A, well, after 3 years in total, we've gotten back $700,000, right? 0 plus 200 plus 500 is 700,000. That means we still need 300,000 of the cash flows in year 4 to totally recoup the cost of the investment. Since we're expecting 600,000 in cash flows in year 4, we need half of the cash flows in year 4. So we're going to assume it's taken 3.5 years to get paid back. Okay. Now, for investment B, after 3 years, you've gotten back a total of $900,000. So that means you still need another $100,000 from year 4. That's 1/3 of the cash flows in year 4. So it must be taking 3 1/3 years, or in other words, 3.33 years to get paid back for investment B. Okay. Now, as far as the net present value and internal rate of return, on your calculator, of course, you got to get into your cash flow worksheet. So you hit cash flow, second clear work. Now your cash flow time period 0 is going to be the cost of the investment. And remember, that has to be entered as a negative number. If you aren't getting correct answers, it probably means that you didn't answer the cash flow time period 0 as a negative number here when doing your capital budgeting. Okay, so you enter a -1,000, that's really a -1,000,000. I'm just doing my numbers in thousands. Okay, and hit enter. Then it says, okay, what's your cash flow for year 1? Well, that's 0. Remember back here, it was 0 in year 1. Enter, hit the down arrow twice, 200,000 in year 2, enter, down arrow twice, 500,000 year 3, enter, and down arrow twice, 600,000 year 4, enter. Now you have all the cash flows in it. Hit the NPV button and it says I equals initially 0. You got to tell it what interest rate to discount those cash flows back to present value. Well, if we go back up here, we see that the required rate of return, or in other words, the WACC, is 9% on both, right? So you put in 9, enter for the interest rate, hit the down arrow and then the compute button, and your net present value for investment A is a -$20.5 thousand. And then you hit the IRR button and hit compute, and the IRR, remember, internal rate of return, is 8.31%. Well, that's less than the required rate of return of 9%, which, remember, anytime the net present value is negative, that has to mean the internal rate of return is going to be less than your required rate of return. Okay? Now, for investment B, we go through the same process. Cash flow, second clear work, and at time period 0, again, we enter the cost of a -1,000,000, enter. And then down arrow, time period 1, your cash flows are 300,000 in year 1, enter. And then when I hit the down arrow, since that happens 4 years in a row, instead of having to keep entering it 4 times over, I'll just, on the frequency of cash flow 1, I'll just put in 4, enter. Now all the cash flows are entered without having to go through and do it 4 times over. You could still do it that way if you wanted to. You could still, I have students that say, no, this confuses me. I'm just going to stick with just entering it 4 different times. Well, okay, if that's what you got to do, that's fine. But it does save you some time if you can just hit, well, the frequency of that is 4. Okay. Again, on the net present value, it asks you to plug in the interest rate, which again is 9%, enter. Down arrow, hit compute. Net present value for investment B also turns out to be negative. In this case, a -$28.08 thousand. And then when you hit IRR and compute, the internal rate of return turns out to be 7.71%, which again is less than the 9% required rate of return, and we knew it had to be because of the fact that it is a negative net present value. Okay. Ooh, this is the 7th inning of a double header, top of the 7th, and it's tied 2-2. Cubs got a runner on second, or a runner on first, nobody out. Just happened to glance up to catch it. Okay. Don't know if there's any other Cubs fans in the class, but or Cardinals fans, because they're playing the Cards. Okay. Problem 2, assume a company needs to raise $10 million. It issues bonds with a par value of $1,000 a bond. Each bond is convertible into 25 shares of common stock. The coupon rate of interest on the bond is 7%. The tax rate for the company is 40%. Assuming a company currently has earnings available to common shareholders of $5 million before adjustment and 2 million shares outstanding before adjustment, what will diluted earnings per share be equal to? So your basic earnings per share is just the $5 million of unadjusted income divided by the 2 million shares currently outstanding, or $2.50 a share. Okay. Now, so we're going to have a new net income figure, though. If all those bonds get converted into shares of stock, we're going to avoid paying interest on that debt. So the total debt, remember, is $10 million. That's how much a company raised, was $10 million. And the interest rate, remember, was 7%. So 7% of 10 million means before taxes, the company is saving $700,000 annually in interest expense. Now, because it's tax deductible and the company's in a 40% tax rate, multiply that by 1 minus the 40% tax rate. The after-tax interest savings, if all that debt gets converted to stock, is $420,000. So that will increase our adjusted net income then from the $5 million to $5,420,000. Okay. Now, what about the number of shares outstanding? Well, there's currently 2 million shares outstanding. Now, to raise $10 million by issuing bonds at $1,000 par value per bond, company is going to have to issue 10,000 bonds. Each bond is convertible into 25 shares of stock. So that's 250,000 new shares. And so that means now the total number of shares outstanding after the conversion would be 2,250,000. So divide the new net income you would have if the bonds get converted to stock, 5,420,000, by the new number of shares outstanding if that happens, 2,250,000, and that's $2.41 a share. So that's diluted earnings per share. By the way, diluted earnings per share always has to be either equal to or less than basic earnings per share. It can never be higher. Yeah, because if something results in a higher earnings per share, it's considered anti-dilutive and then does not factor into the calculation at all. Okay. All right. So any questions on that problem? Finally, the last one. Assume Company A buys Company B. Company A has 1 million shares outstanding and net income of $1 million. Company B has 500,000 shares outstanding and net income of $750,000. The market price of Company A stock is $20, and the equivalent market price paid for the Company B stock is going to be $20. I do that for you on the test too, so that way you have a 1-for-1 share exchange ratio, so you don't have to try to figure out, wait a minute, how many shares am I giving up to the acquiring company for each share of the target company? It's going to be 1-for-1. That's assuming Company A exchanges 1 share of A stock for 1 share of B stock, what will earnings per share for Company A be immediately following the acquisition, or in other words, the first year after the acquisition? Well, you combine the two net incomes, $1,750,000, combine since it's a 1-for-1 share exchange, take the 1 million shares currently outstanding plus the 500,000 new shares they're going to have to issue to acquire the 500,000 shares of Company B. And so the total number of shares outstanding will now be 1.5 million. And so that's going to give us $1.17 in earnings per share. So in that case, earnings per share would actually be expected to go up for Company A after the acquisition. Why? Well, look at, based on those market prices and the earnings per share figures, the PE multiple of our company, Company A, is 20 times, but Company A is only paying an effective PE of 13.33 times for for company B. So since they're effectively paying a lower PE than their own, earnings per share would be expected to go up. But as far as determining the number, especially when it's a 1-for-1 ratio, super easy. Just add the two incomes together, add the two number of shares together. Since it's a 1-for-1 exchange, you get the total shares. Divide the new combined net income by the total number of shares outstanding, and you get $1.17. So, any questions? All right. Well, hey, it hasn't been without its blips and its bumps and its bruises and its scrapes, but we've gotten through this course. So again, Accepi is due. What I have it Saturday night, I think, on Accepi, and the test Sunday night. And meanwhile, I'll grade those Excel assignments. So. Any final questions? I'm gonna get everybody on here that's here. Okay. Any last minute questions? All right. Well, I hope as frustrating as things may have been at times, sometimes due to conditions outside of our control, I hope you still enjoyed the course and learned a lot. And great having you guys in class. Thanks for being here, and good luck on your final.
Thank you.
All right, thank
bet.
you.
Thank you.
You bet.
All
All right, take care, guys.
right, see you later.
Okay. Whoop. Now how do I get out of here? I always have a problem with
So what other classes are you teaching?
right now. This is it, but
No,
then
in
I'll
the
start
fall.
in the fall. I've got this class again at night. No, not at night. Yeah, I don't think I have it at night. Yeah, that just hit me. I've got applied financial reporting in the fall, and then financial management and investments in the fall as well.
Okay.
Yeah,
Like I'm going into money and banking next, but you're not doing that.
I'm not doing that one. No. Do you know who you've got?
I don't know. That's a good question.
Yeah, probably Almer, but I'm not sure.
Anna?
Anna Waterman? No, can't be Anna. Well, unless it's a part-timer named Anna, but I don't know.
Money banking and financial markets, 5th edition. Hello, everyone. I wonder if there's got to be a syllabus up here.
Yeah, I'm guessing it's Almer, A-M-E-R, or Amer.
A-N-N-A, Anna.
Oh, I don't know who that is. Must be a part-timer they found. Okay.
Maybe.
Well, good. Hopefully it's a good course for you. And then, like I say, in the fall, the one night course I have, it's blocks 2 and 3, is applied financial reporting. So,
And I don't think I have that. I will take investments.
uh-huh.
So if you
Yeah.
do that in the spring.
Yeah, actually somebody else teaches that one at night in the spring. I teach it in the day, in the fall. Somebody else, usually we have a part-timer do it at night in the spring. I don't know, that's all still kind of up in the air. It's always possible I could end up taking one of those night sections, but probably the only thing I would be teaching, there we go, Cubs just took the lead. Yeah.
So
All right.
I've got investments, I've got risk management and cases in finance all in the spring at night.
Oh, cases, you'll have me for that one. Yep.
Okay.
You'll have me for the cases one in the spring, and if you're not doing applied financial reporting, you won't have me in the fall. And
No, I'm not doing. I didn't do that one.
yeah,
I decided it was more important to be graduated in May than to just keep taking
Sure.
classes.
Sure. Yeah. Well, you could take that one instead of risk management, because if you're a finance major, right?
Yes, that's right.
Yeah. So that's a finance elective, just like risk management, but it's up to you, whichever one you would prefer.
I'm pretty sure I took the one I did because I have to take law, And I think that didn't conflict with law.
Oh, okay.
That's why they were on the.
Ah, got you.
Yeah,
Gotcha. Yeah.
pretty sure that's why that happened.
Okay. Yeah. Yeah. Well, I will see you again in the spring anyhow, and hopefully.
Hopefully in person, yes.
Yeah, and it's not till Block 6 starts, so hopefully all this shit with coronavirus will be over by then. Let's hope, or at least
Yeah.
at least in a much more manageable situation than we are
Yep. You would certainly hope. All right. Well, hey, thank you. I did enjoy the class very much.
now. Well, good. I appreciate that, Tom. Yeah.
Yeah.
Well, I enjoyed having you in the class, and good luck on your final.
Yes. Thank you.
You
And we'll see you
betcha.
around.
Okay. Take care.